Hey guys, it's Nick and welcome to another video. Today we're going to look at how much my Vanguard portfolio has progressed over the last 30 days. It's been a fairly decent month to be honest, which has really surprised me based on where we left off last month.
Boy, that escalated quickly.
We'll then wrap up towards the end with my thoughts on where the stock market is currently at and any potential changes I'm considering making in the future. I've not fully decided yet on the changes, so I'd love to get your thoughts. So if we look back at where we were around a month ago, VWRL sat just off its all-time highs. If you didn't know already, that is my ETF of choice with Vanguard. It was priced around £77.50, which is only a small retreat back from its peak at £78.50. My account sat frustratingly short of £50,000, which I think at the time I was somewhere around the region of £49,600, with my capital gains around £80,000 mark, which I was really happy with based on the fact that I'd only been investing for 3 years. At this time, I honestly thought the market was a bit of a high and I was ready for the market to come crashing down, if I'm brutally honest. But to my surprise, it's actually been very different this month. Before we jump into that though, if you enjoy these sorts of updates or have an interest in investing, finance or income growth, then please consider subscribing to my channel as it really helps me out. So, where has the market taken my Vanguard portfolio in the last month? Well, for VWRL, it surprisingly marched even higher. In just a week, it jumped 3% to £80.47. Following this, there were some of the big tech players revealing their latest quarterly earnings, including Apple, Microsoft, Facebook, Alphabet and Tesla. The market then did have a little bit of a sell-off, which didn't seem to match the positive results shown by the vast majority of these companies. After this though, it's then quickly recovered in the last week to get us back to around the £80.39 mark. So where does this leave my portfolio in terms of its total and gains? Well, actually, before I get into that, I've got some really truly upsetting news. Vanguard have actually sent their bill through for last quarter. I really don't know how I'm going to recover from this. It was a whole £18.20. I don't know about you, but I bloody love Vanguard's low fees. Let's get to the good stuff then. We've actually smashed through the £50,000 mark and now sit within half a share's worth of 52,000 at 51,963. Which means after my growth and my direct debit of £700, my portfolio has grown by 4.7% in just the last month. In an okay year, you can expect that across a whole year, so to get that in a month, I'm really happy. My overall portfolio gains now sit within striking distance of 10,000 at 9,688, which I'm really looking forward to breaking through. Whenever that happens, or if it even happens. This is when the market's going to sell off now and just spite me. Anyway, it's crazy to think that just 11 months ago, I was actually sat in a negative of 3,200, so I'm really glad I had the stomach to hang on at the time. For me, I'm also glad that I'm sticking to my own advice. I'll throw back to a comment I made a few weeks ago about buying at all-time highs. You also need to consider the stock market spends roughly 24% of its time within 2% of its all-time highs, which is incredibly often. Being worried to invest at all-time highs may keep you out of the market nearly 1 in every 4 days. If this is going to put you off, then you might not invest at all. I'm back to present self, and this still holds true now. Even though we're at all-time highs, my direct debit is still going to go out in 2 weeks' time. So where is the stock market right now? For me, I always like to take a look at the website currentmarketvaluations.com to see what all the latest indicators are saying. At a quick glance, we can see that they're currently saying it's fairly valued, strongly overvalued, strongly overvalued, overvalued, and fairly valued. I think it's fair to say that the majority of indicators are saying that the market is most likely a bit too hot at the moment. The graph I actually found most interesting is the interest rates model, as it's the only model that's taking into consideration how historically low interest rates are at the moment. As we can see from the graph, it actually considers that since the dot-com bubble, the market has actually trended undervalued for some time, mainly driven by low interest rates. The model isn't perfect, just like how no model is perfect, but it helps give context to where we are now versus where we've come from. So where do I think the market's going? Well, the stock market price is a beautiful equilibrium. Shout out to anybody who's taken basic economics, which is the sum of the upwards and downwards pressures on the market. In a nutshell, I don't think there is a hell of a lot keeping stock market prices down other than poor earnings at the moment, which, if we think about it, should be the only and biggest factor for share prices, but sadly it isn't. Let's take a look more deeply at earnings growth. As you can see, we haven't had any solid earnings growth since the start of 2018. And what has the stock market done in this period? It's up around 45%. So there's something not quite right going on here. So what are the upwards pressures? There's a lot of different examples, but I'm going to stick to the biggest two. The first is the printing of money. Governments around the world have been printing money by the boatloads to support asset prices, to try their best to prevent a recession and to keep the economy afloat. Historically, governments have been far more sheepish before printing money due to fears around inflation. But today, if you want to put a positive spin on it, you could say that we're quicker thinking in a crisis to try and stop the damage before it's already started. But from a negative point of view, you could just say that we're more willing to push the problem down the road, so print loads of money today to help stabilise the economy, but then hyperinflation in the future that could cause more issues. But why haven't we seen inflation across the board already? For me, it's down to the velocity of money, as people aren't out there spending. But once people start spending again, I think we'll see inflation shoot up. Investors know this, so they much prefer to have the money tied up in assets than left for their cash to be eroded by inflation. The second is interest rates. Interest rates around the world are starting to look a lot more like Japan's, and if you didn't know, Japan's interest rate has been pretty much zero since the mid-90s. But why does this influence the stock market? Well, it's primarily driven by two factors. The first is that any debt that companies carry have a lower interest rate, so they've got to pay less to have that debt. So profits can be higher, which means their share prices can increase. And the other is other competing investments like bonds and interest you might get from money sat in your bank account are practically zero at the moment. So investors have to seek more riskier assets like stocks and shares to get a decent return. So what does this mean for the stock market in the future? If interest rates are the biggest factor, then we can expect the stock market to start to devalue a little bit as interest rates start to rise, as individuals are going to take the money out of the stock market and put it into bonds and maybe high interest bank accounts or something like that. I think this will happen, but when interest rates do start to rise, it will be due to people out there spending money, meaning the velocity of money is increasing, which will cause inflation. I think these will be quite balancing factors, meaning that the stock market will actually probably stay quite level for a period. I think we're most likely looking at some form of a lost decade than anything else. I don't necessarily think it's a negative thing, I just think the stock market has a lot of rebalancing to do. But the beauty of it all is that no one has any idea.
Nobody. I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or circles.
I am still bullish on the stock market in the long term, and I'm sticking to my boring strategy of dollar cost averaging. But I would love to hear your thoughts on this. So does this change my investment strategy in the near term? Based on these factors, not really, but I have had a slight change of heart over the last 4 weeks. I'm not one to jump on hype trains or anything like that, but I am trying to understand more about blockchain technology. Before you think I'm going to start screaming at that Dogecoin is going to 100x in the next week, then just give me 2 minutes. I still have a long way to go in terms of educating myself on blockchain technology, but from what I've read so far, I'm starting to understand to see how it could actually significantly disrupt the businesses I'm currently investing into. I don't think it's necessarily likely, but it's actually a lot more realistic than I previously thought. Originally, I thought blockchain was just a way of people paying each other, but it's a lot more than that. Off the back of this, I'm considering forming a 1-2% position in cryptocurrencies. You could say I'm looking to form a blockchain version of VWRL. If you have any recommendations for books on this topic, then I'd be extremely grateful if you could recommend them in the comments below. Anyway, that's all for this video. Let's see where we get to during March. If you've made it this far, then a massive thank you from me. I also create other content, like looking at the success that Cathy Wood's had at ARK Invest and explaining how she does it, and what we can learn from her. And then another video that I'm quite fond of is 5 inconvenient truths about investing. Link should be on the screen right now. That's all for this video. See you in the next one.